I'm talking about special offers now. So special offers, it's a decision to take special business. So it's additional business based on incremental costs and incremental revenue. So we're saying here, really the thought is we have a limited amount of time and a limited amount of resources. That's the thought for all of this, right? For special offers, for make buy, all of the stuff we've talked about so far. Here, we already decided everything else. We've decided what we're going to build. We're decided how we're going to do it, the amount of hours we're going to work. And now someone came in and gave us a special request. We're selling $100,000, 100,000 units of a product. We're operating at 80% capacity, and we have this following contribution margin statement. And a buyer of the product asked if they could buy additional units of the product so they could export it to another country. And so now we have to ask, do we have capacity? Should I accept it? Is the pricing going to be worth it? Normally these special offers are at a discounted price. From a professional service standpoint, this happens all the time, where maybe I'll be working, I have my clients that I work with weekly, monthly on some basic recurring activities, maybe a phone call, maybe some advice, but then something comes up and they say, hey, can you spend 5 hours to work on this one quick project? And you have to make a decision. Do I have the time to do that? What price are they going to pay me? Do I have to charge them a surcharge? Am I going to have to sacrifice another project to work on it? So always we have to assess, do we have capacity? Do we have the resources available? We'll have to make a sacrifice somewhere else. So let's look into, should we accept the offer? So always write down the facts. So we know that, what's the offer? We always want to know that first. What do they want to buy? Units. They want to buy 10,000 units. Cool. They want to buy at a price of $8.50 unit. So right away, I think, is this higher or lower than my actual price per unit? And so I'll look, and our normal price per unit is about $10 a unit. So our normal price. So they want a discount because they want to commit to 10,000 units. That's fair. Let's see. That's $1.50 lower than the current price. The offer price is low, but we're considering the proposal because the sale will be several times larger, right? So it's very common for companies. We want to give them a discount because we get a large order, right? Same thing. I give a discount to some firms that sort of service me because they work with me and give me 10 hours of work a week or 20 hours of work a week. Maybe I'll charge them less than my $200 an hour rate, right? Because they give me consistent work, more volume. And so should we take this discounted price, and instead of our regular business, we're operating at 80% regular capacity. These 80%, and what's our current production is 10,000. So what are our 100,000? So our question here, a few things we have to ask. If we sell it at $8.50, will we even make a profit? Second is, if we do make a profit, would we have to sacrifice some of our other production for it? And so let's go into that assessment. And so to determine whether to accept or reject the offer or order, management needs to know whether accepting the offer will increase net income, right? That's the end of the day. Will we increase net income by accepting this offer? So if we accept the sales per unit, here we're going to look at an additional revenue of $850 times 10,000. That's our $85,000. We're also going to increase our variable costs. So our variable costs here, we go back to our financial statement. We have about a $240 contribution margin per unit. We're saying here our contribution margin for this is $210 because of the lower price. So let's see, $350 of direct materials. I'll add it all in here. Minus $220 for direct labor, minus 0.5 for variable overhead, minus 1.4 for selling expense. So all of those should 0.5. So we're saying some of this got revised per unit. And so those will be given to you. But what they're saying here is we're going to be paying less we're the same for our direct materials and direct labor, but we're going to have less overhead and less selling expense because we don't need to market this material, and we can build this all in one batch rather than maybe a lot of different shifting costs. So we lowered these two, but I think fairly didn't drop the direct materials or direct labor, and that would be given to you, and we decide that as a business. And so our variable costs here, if we add all these up and then multiply it by the 10,000, we get 64,000 in additional costs. So our contribution margin is going to be 21,000, or per unit. We just divide it by here. It's $2.10 per unit. That's where we're getting this $2.10 from. We're also saying our fixed overhead will increase. We maybe had to pay our administrative person overtime for their salary or hire someone additional. So we're saying that the fixed overhead is increasing by 0.1. So $2 per unit annual total, we're going to get an extra 10,000, 20,000 in operating income incremental. So if we're getting that, yes, of course, we should accept the revenue. Of course, we should accept it. But the question here is, do we have the capacity? And so our capacity also is 80% times. So we originally have a production of 100,000. So we'd have to say, what is our actual capacity? And so our capacity here, what times 80% equals 100,000? And so we could take the 80,000 divided by 80%. Our capacity is actually 125,000, right? Because 125,000 times the 80% equals our 100,000. So since our capacity is 125,000, all we're asking for is 10,000 additional units. We have the capacity. So since we have the capacity and we'll make the money, then we'll make this decision. And so that's hopefully that all makes sense. In cost accounting, you'll get more complex ones, and maybe I'll throw some on the homework where you don't have the capacity. If we don't have the capacity, then we always take the higher profit. We maybe don't. So let's say our capacity was 100% here. We wouldn't take it because we'd actually lose money on this special order because we make more money with our original orders. So we're kind of back and forth if we have capacity and will we make a profit from it.